back to the explainer, traders. Let's dive straight into today's high-velocity overview. We're breaking down the overnight macro shocks and, more importantly, the actionable technical setups you absolutely need on your radar for today's session. We have a ton of ground to cover, so let's just get right into the data.
So, the massive overnight shock that literally reset the board? A 0.3% monthly drop in the U.S. headline producer price index. I mean, wow, it decisively beat consensus forecasts, and coming right on the heels of that softer CPI print, it just sent U.S. yields tumbling. This downside surprise is exactly the catalyst setting the stage for today's price action across the majors and equities.
All right, let's kick things off with global macro and geopolitics.
We are trading through a pretty wild divergence right now. On one hand, you've got escalating geopolitical tensions in the Middle East. With the U.S. striking Iranian assets and Kuwait intercepting drones, supply risks around the Strait of Hormuz are keeping Brent crude stubbornly elevated right near $84 a barrel. But pitted squarely against that, the global economic engines are definitely cooling. China's Q2 GDP completely missed expectations, expanding just 4.3% on weak domestic demand, and Eurozone industrial production is actually contracting. So inflation might be cooling, but global growth definitely has one foot heavily on the brake.
Which brings us directly to the economic data and the Fed outlook. There's a really fascinating contrast in the messaging today. You've got the Fed's Beige book painting this rosy picture of AI-supported expansion, and obviously markets are cheering the soft PPI data. But then you have Chair Kevin Warsh holding a very firm anti-inflation stance. His warning is clear. Policy is totally data-dependent. And celebrating inflation victories too early, well, historically, that's been a very expensive hobby.
Okay, let's zoom in on the global currency technicals and see how this plays out on your screens.
Starting off with the dollar index, the DXY took a sharp dive on that soft PPI print, and the structure is now testing a really critical pivot right at 100.47. Tactically speaking, buying the USD here is a solid setup, but only if you use a very tight stop. If we lose 100.47, the next floor is down at 100.25, and if that breaks, the whole structure shifts to a strict sell-on-rise theme. Keep your eyes on the upper resistance bounds at 100.57 and 100.89, especially as we head into today's U.S. retail sales numbers.
Moving over to the euro. EURUSD obviously spiked on that dollar weakness, but let's be real, the fundamental reality in Europe is totally capping the momentum. Eurozone factory production just plunged a massive 1.2% annually. Because we don't have that fundamental momentum support, the technical structure is a strict sell-on rise. Watch resistance at 1.1483, but your absolute line in the sand is the 1.1508 pivot. We need a structural break above that pivot to even think about a bullish chart. Downside support sits at 1.1447. Over in Japan, USDJPY is honestly just ignoring the global noise, stuck in a super tight range. Domestically, though, it's turbulent. Prime Minister Takaichi just publicly rejected any blame for the Nikkei's recent 5% drop. And to add to the drama, those explosive Bank of Japan transcripts just dropped, revealing their historical negative interest rate rollout was highly contested. I mean, that shocks absolutely no one, but it does reinforce a likely hold for their July 31st meeting. Tactically, this chart is tricky right now. You want to look to buy only on a clean break of 162.71 or, flip side, sell at that exact level with a tight stop at 163.00.
Let's pivot to the Asian session and break down Indian equities and USDINR.
So, the Nifty staged a moderate, albeit pretty volatile, recovery, closing up 0.11% at 24,078. For you active traders, the chart formed a doji candle, which tells us there was a serious midday tug-of-war happening. We had strong banking and financial momentum acting as pillars, but they were battling severe drags from the IT sector, thanks to IBM's weak revenue outlook spooking things and some real weakness in metals. So the technical structure is still buy on dips, but please tread with caution. Key support is 23,900, and if that gives way, 23,576 opens up fast. Upside resistance is clearly defined right at 24,344.
Looking at the rupee, USDINR ended nearly flat at 96.25. The pair is wedged incredibly tightly right now between foreign portfolio inflows and some heavy dollar demand from local corporates. Crucially, though, the bulls found an anchor, securing a second consecutive close above that weekly pivot of 96.06. That really reinforces a buy-on-dip strategy. If we can push through the ceiling at 96.18, your next target is 96.90. Key supports to watch below are 95.82 and 95.43.
Finally, let's map out today's key data watch.
Today, the market spotlight shifts aggressively away from inflation and directly onto the consumer. We've got a packed slate ahead. We start with UK growth and manufacturing data, followed by critical US June retail sales, jobless claims, and the Philly Fed survey. Oh, and we also have a major Bank of Canada policy decision on deck. The microscope is heavily focused on business activity and consumer spending for the next 24 hours.
Which leaves us with one final, absolutely crucial question. With inflation decisively cooling down, but global growth clearly tapping the brakes, are consumers actually resilient enough to carry the next leg of this market rally? You've got to keep a very close eye on those consumer metrics today, because they are going to dictate whether these technical setups hold their support or completely break through key resistance. Thanks for joining this explainer, everybody. Trade safe out there, and I'll catch you on the next one.